Your bank pays you 0.01% interest on your savings, then turns around and lends that same money out at 7%. So where does the difference go? Banks are some of the most profitable businesses on earth, and almost nobody actually understands how they make their money. Today, we're breaking down the real business model behind a bank. No jargon, just the mechanics. It's not just interest. A modern bank actually runs three completely different money machines at the same time. Interest spread, fees, and trading. Let's go through each one. By the end of this, you'll never look at your bank statement the same way again. The first money machine is the oldest one. The interest spread, or what bankers call the net interest margin. You deposit $1,000. The bank doesn't just let it sit there. It lends most of it back out to someone else. You might earn 0.5%. They lend that same money out at 7% for a car loan or a mortgage. On just that $1,000, the bank can pocket around $65 a year, doing almost nothing. Now multiply that by millions of depositors and billions of dollars in loans, mortgages, car loans, credit cards. That gap between what they pay you and what they charge borrowers is called net interest income. And for most banks, it's still the single biggest source of profit. Money machine number 2 is the one that gets banks in trouble the most. Fees. Overdraft fees, ATM fees, wire fees, monthly maintenance fees, late payment fees. These add up to billions of dollars in pure profit every year, money that costs the bank almost nothing to collect. Think of it like a toll booth. Once the infrastructure, the app, the card network, the branch is built, every fee is almost pure margin. Card fees work the same way. Every time you swipe, the merchant pays a small percentage, and a slice goes straight to your bank. It feels small per transaction. At the scale of a bank, it's a massive, steady revenue stream. The third machine is the one most people picture when they think bank, but it's actually the most complex: trading and investment banking. When a company wants to go public or raise money by selling bonds, banks handle that for a fee that can run into the millions. This is called underwriting and advisory work. Banks get paid to structure deals, IPOs, mergers, and acquisitions. When two companies merge, the banks advising both sides can earn tens of millions in fees from a single deal. On top of that, big banks also trade with their own money, buying and selling stocks, bonds, and currencies to profit from price movements. This is called market making, profiting from the tiny gap between the buying price and the selling price, done millions of times a day. Let's put real numbers on this. Take a major global bank's annual report. The revenue breakdown tells the whole story. Roughly half the revenue comes from that interest spread we talked about. About a quarter comes from fees and service charges. And the rest, often the most volatile part, comes from trading and investment banking. Three completely different businesses operating under one roof, one brand, one banking license. That's why a single bank can survive a slow year in one area, because the other two are picking up the slack. But here's the part banks don't put in their commercials. This whole system depends on trust. Remember, your deposit isn't sitting in a vault with your name on it. It's already been lent out to someone else. If enough depositors panic and try to withdraw their money at the same time, the bank simply doesn't have it all on hand. This is called a bank run, and it's exactly what happened to several banks in the 2008 financial crisis. When the trading side of the business takes on too much risk, and the interest rate side gets squeezed at the same time, the whole model can crack. That's exactly why regulators force banks to hold a cushion of capital, a buffer for exactly this scenario. Every major bank is required to keep a percentage of its assets in reserve untouched, just in case. This is called a capital requirement. Think of it as a financial seatbelt. It's set by international rules like the Basel framework, and it directly limits how much risk a bank can take with your money. So every bank is constantly walking a line: take on more risk for more profit, or stay safe and grow slower. That balance is decided in boardrooms every single quarter. So what does all of this actually mean for you as a customer? It means the interest rate you're getting on your savings account isn't random. It directly reflects how a bank is choosing to make its profit. A bank with fewer branches and less overhead can afford to pay you more because it's spending less on fees and staff. That's part of why online banks are often able to offer higher savings rates than traditional ones. It also means it's worth actually reading your statement. A lot of fee income only exists because most people never notice it. Understanding these three machines, spread, Fees, trading, is the first step to not being the fee income in someone else's pie chart. Let's bring it all together. 1. The interest spread, paying you little, lending it a lot more. 2. Fees, the quiet high-margin toll booth on almost everything you do. 3. Trading and investment banking, the complex, high-reward, high-risk engine behind the scenes. 3 very different businesses, 1 balance sheet, 1 license, and underneath all of it, the entire system runs on one fragile thing: trust. Which is exactly why regulation, reserves, and transparency matter as much as the profits themselves. So next time you open your banking app, you'll know exactly which of these 3 machines is quietly working in the background. Hit subscribe if you want more breakdowns like this. No fluff, just how the money actually moves.